Welcome back, traders. Today I'll be taking more lecture notes on ICT's 2025 lecture series. Got another review today, this time with Forex and Nasdaq futures. Man, he's been dishing out the Forex a lot lately, but I don't trade Forex. I'm not bothered because his concepts work for both asset classes. Again, I would like to ask you to help me out by giving this video a like and subscribing to help me get over 1,000 subs. I really appreciate you. Thank you so much, and let's get started.
Hey folks, welcome back. Today's Wednesday, February 5th, 2025. It's going to be a really short Forex and Nasdaq review.
Haha, real short. You know when he says this, it's going to be a long one. This video is 48 minutes long. I may skip through some of it and just summarize for you the stuff he's repeated before, but anything really important or new, I'll make sure to play it out. So he starts off with the dollar index. He's gone over this in the previous video. We have the daily chart on the left and the 1 hour on the right. He gave an analysis on the 4th where he's looking for price to trade through this weekly fair value gap and then come back up to use as resistance and then run for the sell side liquidity. So far, it has not traded through the low of that weekly fair value gap. And looking at the hourly chart, we can see the bodies are currently respecting consequent encroachment and closed near the high.
15-minute time frame, you can see we used sell side and bounce buy side inefficiency here, breaking the low, coming back up. It is basically working inside the upper half of an inversion fair value gap. Eventually, we want to see it trade down to the low of it and outside of it, and then have no willingness to want to get up in this area here, but stay at the consequent encroachment level and lower. And if it displaces from that point lower, the very first lower time frame fair value gap that can be shorted, that's how I look at using inversion fair value gaps. 5-minute chart on dollar index, much of the same thing here, just banging back and forth in the upper half of the inversion fair value gap.
So the pound dollar was a stronger pair compared to the euro dollar. So he favored longs on that one. It was able to hit the buy side target first. Euro dollar lagged behind but eventually followed suit and also went to the buy side as outlined in the review on the 4th. Now let's go ahead and hear him talk through the price action.
All right, real quick, we're going into pound dollar. Left-hand side is a 15-minute time frame. You can see here we had order block here on a 15-minute time frame. Buy side bounce, sell side efficiency, fair value gap. Hits that. That's a really good setup in and of itself. Rallies higher, another buy side bounce, sell side efficiency, consequent encroachment, leaves part of that open like that. That's going to be strength if it can rally out. It does. And runs up into, one more time, immediate rebounds, and then sends it above our buy side liquidity pool. All right, we're looking at a euro dollar chart, 15-minute time frame on the left-hand side. And pound dollar was able to hit our target first, which was a buy side liquidity pool. And then euro dollar was a little bit of a laggard. All right, so we have a order block here. Rallies higher. Comes back down. Reacts. Another order block here. Same here. Hits it, trades up, falls short of the buy side liquidity pool, comes down one more time, hits it, and then punches through that. In the 5-minute chart here, you can see all of the order blocks in here. You can see them reacting off of the 5-minute chart. Now, I want you to think about how this price action looks. Lots of whipsawing back and forth and overlapping previous ranges a lot. That is a high resistance liquidity run condition, meaning that your stop losses have to be very generous. You can't be trying to trade with a 1 pip, half a pip. Some of these guys at some mentorships try to tell you they do. The likelihood of you staying in the market with a very, very tight, ultra small stop loss in the present climate is highly unlikely. Okay, there's trade wars on which will roll over into equities markets. Looking at the 5-minute chart, you can really see the exaggeration of it's like a fuzzy chart. And they can be traded, but it requires you to hold on to the positions with a little bit larger stop loss, less leverage, and be a lot more patient. And true to form, it hit our buy side liquidity pool, and that was the second expectation for Forex. So pound dollar hit our target, euro dollar hit our target. Dollar did not go below the potential inversion fair value gap because both euro dollar and cable or pound dollar have both met my weekly objective by hitting those buy side liquidity pools. I'm personally no longer interested in it. So I don't care if the dollar index does what I was expecting to do. It was used as a catalyst as a 3-market triad, where I'm not just simply looking at the euro dollar and thinking, am I bullish or bearish? That's not good enough. You have to look at a closely correlated market like the pound dollar, and if it's bullish and you're trying to trade euro dollar bullish, wonderful. Then you should be able to confirm that one step further by seeing a bearish dollar. So there's always these extra steps when trading Forex, which, again, it's more advantageous for you to trade futures because it's pretty much straightforward. You're looking at one market. You really don't have to look at anything else except for the index. It's it. But I understand there's a lot, most of you, as my students, are Forex traders. I'm just reminding you that you just can't simply look at one pair that you're going to trade and think that you have a full grasp on all the considerations that's going to have an impact on the delivery of price in that currency pair.
So high resistance liquidity run conditions require a wider stop and not moving that stop so quickly. It's definitely something I'm looking to improve in my trading. Oftentimes I have the right idea, but I trail my stop too quick and too tight that I get knocked out before I can fully realize the trade. Like I said before, backtesting will help me out with this. I'll be working on those videos soon, so stay tuned for that. But also, I want to mention that for futures, I look at both ES and Nasdaq since they're closely correlated, and also sometimes the dollar index. So even for futures, you do have somewhat of a triad.
All right, running right into E-mini Nasdaq March delivery contract, 15-minute time frame on the left-hand side. I counseled you in the Telegram channel yesterday to draw your February 4th, which is Tuesday's first percent of fair value gap, extend that to the right, okay? And the market traded lower down into it here. And look how it delivered. Where were the bodies at in the upper half? Did it even close on the consequent approach from the midpoint of it? No. It did wick outside of it, but that's permissible. That means we allow that to happen. This is indicating that it's likely to go higher. So the market rallies back higher. And look at all of these wicks on both sides of the marketplace. See that? That right there is high resistance liquidity run conditions. That means you're likely to get stopped out. I got stopped out, but I did an execution, and I'm going to cover. Go through the audio clips and you'll hear me talk about taking Tuesday's first percent of fair value gap, which is this pink area down here, to extend it to the right. And it was likely going to draw down into it. And it happened this morning at 5 a.m. Eastern time. And you can see that over here on the 5-minute chart. So the London setup was this sell side and bounce, buy side and efficiency. Market trades up into it there. This little wick is okay. During the London open kill zone, breaks lower. This sell side and bounce, buy side and efficiency is going to act as an inversion fair value gap. So we want to see it stay in the lower half, which is what we're seeing here. And look at the bodies. It's not even willing to get up in there. So is that indicating strength or weakness? Weakness. So the market does what? It drives lower, takes out that low, and trades right into Tuesday's first percent of fair value gap.
Okay, so he rants here for like 10 minutes, talking about how he was proving the algorithm exists by calling the price action in Tanya Trade's live stream. Basically, after the opening bell, he calls for sell side to get taken first at around 21,500, and then he was looking for the buy side at 21,615. Now, I assume he took a trade on this, so I'm going to let him talk for a while and walk us through the price action.
1-minute chart on Nasdaq, March delivery contract 2025. It's a 1-minute chart, and we're showing it in regular trading hours, okay, RTH. When you put your chart on RTH, what it's going to do is if there's a discrepancy between the previous day's settlement price and the 9:30 opening price Eastern time, you'll see it in the form of a gap like it did here. Okay? So if we open lower than the previous day's settlement in RTH or regular trading hours, that is called a discount opening range gap. Opening range gap high when it opens lower at 9:30. The opening price at 9:30 is the opening range gap low. Notice this low over here? That's not what you see in my recording, but it's based on the logic that we had already opened up at that low and went lower. Traded up into the gap a little bit, one more time, but did not completely close it in. The market drops from there, takes out that short-term low, and causes individuals to see this as a continuation pattern known as a bear flag. Now, I'm saying that here, and you're saying to yourself, if you're a brand new viewer, it's easy to say this stuff in hindsight. But I'm going to counsel you to go back and watch the recording where I'm typing it out in not Telegram, but in TradingView's platform. Okay, you can see me typing it out, and I say at a very specific moment that now retail traders see this as a bear flag. And I also state when it trades down and validates that bear flag, I say at this moment, retail traders are now trapped, and then the market's going to go higher, and it's going to have a big reversal to the upside. All these components with this sell side being taken here, the fact that we had a discount opening range gap, that means it's likely to see the market trade up mid gap. But what happens if we have relative equal highs above the marketplace and we're part of a market that's bullish too? Well, that means that we're likely to see not only just the gap closure between 930's opening and the previous settlement price, it may go through that gap closure and keep going higher. So here is our opening range gap, and you can drop a fib when it's a discount opening range gap. That means we open lower than previous day's settlement there. So here we have lower opening. You draw your fib from that closing price to the opening price. And there's your quadrant levels, okay? Look at the sensitivity, how every one of these candlesticks, they stop and they turn, they hug that level here at consequent encroachment. We come back down one more time. Look at the bodies. They're not even respecting that level here. The wicks get down to it and throw it, but the bodies are saying, no, it's about time to start rallying. I got stopped out by railing up my stop loss real tight because I wanted to go onto Twitter. I wanted to see the buzz. So the point is this, the market trades down and then picks up the discount inside this balanced price range. What makes this a balanced price range? Single down close candle is a SIBI. Single up close candle is a BISI. So the market's not likely to go past this. It can trade into it, but it's not likely to go over top of this and go lower. We're seeing it do it here, and it starts to rally up. One more time, touches the high of the opening range gap, and rallies up and trades into a higher premium level that I even called for today. So with that logic, we're going to take a look over here. Now we're in electronic trading hours right here in the lower right-hand corner. Relative equal highs here. And this is more or less the 4 p.m. high.
Pausing for just a sec, I'm glad to see that I was aiming for the same buy-side liquidity as ICT. I did get in pre-market, but I was trailing my stop tight and I got stopped out. I thought to myself, okay, it's NFP week and my family wants to spend some time together, so I decided to just close the chart and end the day with a tiny profit. But very happy to see that I was on the right track for the overall day's narrative.
We have the relative equal highs up here where there's the buy side. And then we have the opening range gap high, which is previous day's regular trading hours settlement price. So we opened up, did all this back and forth price action in here, and then eventually traded higher and then ripped even higher into that buy side. But notice that during the London session ending at 5 a.m., that's when we get this first percent of fair value gap from Tuesday. We have a nice turning point here. That's the low of the day. And the market rallies up into a draw on liquidity here. But let's get some detail. Let's pull back the veil on market wizardry, if you will. Let me show you something in here that no one else is going to be able to teach you, okay? Can I do that? All right, so we have price zoomed in. We have the opening range gap that's shown here. And then look right here. See these relative equal lows? Now, it may not have been obvious to you when you were watching price this morning. But if you listen to what I shared in the 2024 mentorship on my YouTube channel for free, I taught how to look in pre-market for these areas like this. If you have a bias, if you have a draw on liquidity, which in this case is 21,694, which is the relative equal highs from the previous day, it's likely to continue going higher on the daily chart. And then we have this obvious pool of liquidity where there's relative equal highs. So that's a smooth area. And the market tends to make that jagged. Smooth edges become jagged or are made jagged. That was the little catchphrase I came up with in 2024. Well, the same thing's here. These are smooth edges, relative equal lows. So the market's going to do what? It's most likely going to go down here and disrupt that smoothness, and it does so here. See that? Now, let's go one step further and prove logic that this algorithm uses. Because if you've ever studied higher order math and or science and or algorithmic science, if you've ever worked with an algorithm, you have to have data. You have to have, not only do you have to have logic and syntax, but you have to have data. So what I'm showing you is what data arrays, which is what I call my PD array, premium or discount array. What specific prices, not zones. We're not talking about supply and demand zones, which is a myth. Sounds clever. It's just a twist on support and resistance. But I'm telling you very specific price levels. And I'm cutting through all the other ones that aren't really there. That's what you should be noticing in that Telegram channel. That's what you're about to see here. So if we take price away, and we have known price levels now, everything else except for what I'm showing you right here doesn't exist.
All right, guys, get ready for something magical. I've never seen something like this where he takes away all the candlesticks. I do understand the whole concept of, the algorithm needing data and stuff, being a computer science background myself. Well, let's see what kind of magic show we're going to see right here.
We have the draw on liquidity. That draw on liquidity is indicating the market's like to draw up there. Okay, so you can build a bias that it's going to be bullish. The next price that's static is at 9:30. Whatever that price is at 9:30, it cannot change. So we wait for 9:30 Eastern time. So that is your opening price at 9:30, and that is your regular trading hour reference point. And then you compare that with the previous day's regular trading hour settlement price. You see how they're static, they're constants. Once they're there based on time delivery, all you're going to do is wait for the reference that's useful for it. In this case, it's the 9:30 opening price. Where are we at in relationship to that previous day's settlement price? Higher or lower? In this case, we opened lower. And we have a draw on liquidity in a potentially bullish market, and we're looking for 21,694 as the upside draw. So we know what? The likelihood is that the daily range is going to go higher. Does it close on the high? We don't need it to do that. But we're looking for reasons to justify an entry to get into this market long. But can we just buy anywhere? No, you have to buy in a discount. Then we have an obvious relative equal low sell side liquidity pool. So now we know there's stops there. We know the opening price at 9:30. We know the previous day's settlement price and regular trading hours. And then we know the draw on liquidity. Nothing else matters yet. So now, because we have these reference points, we can now take a look at it from an algorithmic delivery mechanism. Because we open lower, the likelihood of that gap that's shaded, it can see it do that. There's nothing wrong with that. It can do that. But normally, if you're bullish and you're expecting higher prices, it can do something like this as well. It can open up right at the opening and just go straight right to it. And there's nothing you can do about it. Sometimes you're going to miss moves. I miss moves sometimes like that. I can't be a part of it if it's too fast. But today, I used the IMP24, which is something that I can't teach that part to you, but I can showcase it. I can prove to you in my hands, this is what I know, and nobody else knows it. So it's kind of like me snubbing my nose at the people that say, there is no algorithm and this guy's a fraud. Okay, explaining away this. The market opens at 9:30. I know that it's likely to draw up into that gap, but I don't think it's going to completely close the gap. Why? I'm going to show you. It starts off by going up there. That's why I said I like 21,615, because I was trying to time and pick the very price that it was going to go up to, but not close in the entire range of that gap. Then the market drops, goes after the sell side. Why? Because at first run up in there, people want to see that gap close. A lot of people know gaps need to be closed. Gaps have to be closed. Gaps like to be closed. Not initially. They don't have to do it right away. It can be deferred. So by dropping down there, everyone that bought it trying to get that gap closure, they're getting crushed. And their stop loss that's below the low of the day, or if they're using this area down here as a stop loss location, they're rated. I know that this is going to happen. So I'm going to buy as it does that very thing underneath at 21,508. Then I'm going to expect the market to go up and close the gap. And then if I can still hold on to the move, get that ride up into the buy side liquidity there. Ultimately, this is my power 3. Now let's take a look at it in price action. What this is suggesting is I want to be buying at the opening price at 9:30 in regular trading hours or lower in that green box. And then also there's our first percent of fair value gap. Now I rushed in the recording to draw it because markets are moving around, but this is how the gap should look. You got to include that volume imbalance. As it goes below the sell side liquidity pool here, I'm buying it. I'm waiting for it to dive down there and buy that because I know what I just outlined is likely to occur. There are my entries. Notice how they're all grouping below the first percent of fair value gap area here. And it's inside there too. A couple of them right at it. Is it right there? That's one there. And it's below that sell side liquidity pool. So every PDA rate it formed, while it looked like a bear flag a couple different times in here, it's not. I'm buying all that up. And I'm showing every single PDA rate that was available at the time in the recording. Watch the recording for today, okay? February 5th, 2025, that execution video on NQ. You'll watch me do it live and am executing on it with a very, very small stop loss. Now here's the execution label so you can see the actual prices. And then it delivers above the opening range gap high. And then I bring the stop loss up here because if it stops me out, that's fine. I can go to my favorite haunts on YouTube and see what everybody's saying. If I wanted to keep it wide, then I potentially could have got stopped out and gave up more of the open profit. But because the volatility is off the chain right now with all of the tariffs and whatnot, it's better for me just to bring the stop loss up because it's done enough. And then ultimately it did go up to where I said it was going to go. Okay. And also had a midpoint level, which I taught last night in the reveal, where you have 2 liquidity pools. And if you're bullish, find a halfway point between that. And that's a buy sell liquidity pool as well.
Okay, very cool video. I did check out his trade example video. I'll link that in the description. He had his initial stop at 497, so less than 10 points. The power of 3 concept, he's taught that before in the core content and in the 2022 mentorship, but not so much in the 2024. So if you're interested in that, I urge you to seek it out in those playlists. But that's all for my lecture notes this time. Make sure to like and subscribe as I study more lectures in 2025. And until next time, safe trading.